Let's zoom out today and look at the bigger picture, because the mainstream media is missing the forest for the trees. We are just days into the new year, and the situation in the Caribbean is already reaching a boiling point. On December 17th, the U.S. Navy officially initiated a blockade of Venezuelan waters. You might have seen the headlines about the seizure of the oil tanker named Skipper, or the reports of 11 other Shadow Fleet vessels making a sudden U-turn and fleeing back to port. The narrative they are feeding you is one of strength and control. They want you to believe that Uncle Sam is finally flexing his muscles and shutting down the flow of illegal oil. But what if I told you that this entire military spectacle is just a distraction? What if I told you that while the U.S. Navy is playing a high-stakes game of cat and mouse on the high seas, a much more dangerous war is being lost in the banking system? This isn't just about oil tankers or rogue regimes anymore. This is about the money in your pocket right now. While Washington burns billions of taxpayer dollars chasing ghost ships, Beijing has quietly activated a financial trapdoor. It is a strategy so counterintuitive that most Western economists didn't see it coming until it was too late. They are using America's own tariffs as a weapon to destroy the dollar's dominance. I call it the reverse trap. And if you don't understand how it works, you are going to be the collateral damage when the fallout hits your retirement account in 2026. So buckle up. In the next 20 minutes, I am going to expose the silent theft of your wealth. I am going to show you why the U.S. government's military victory is actually a financial defeat. And most importantly, I will show you exactly what China is doing with their currency right now, and why it signals the end of the fiat dollar era. The military decoy. To understand the financial trap, we first have to look at the bait. The bait is the military escalation happening right now off the coast of South America. The U.S. Navy has deployed significant assets to enforce this blockade. It looks impressive on CNN. It sounds tough when politicians talk about it. But let's look at the reality of what is happening on the water. Take the case of the vessel known as Yuan. This tanker was tracked carrying Venezuelan crude, heading straight for a Chinese refinery. When the U.S. Navy attempted to intercept it, the crew didn't surrender. They didn't stop. Instead, they pulled a move straight out of a Hollywood movie. According to satellite intelligence and reports from Al Monitor, the crew of the Yuan painted over the ship's name while still moving. They lowered their flag and raised a Russian tricolor. Suddenly, intercepting this vessel wasn't just a law enforcement action. It became a potential diplomatic crisis with a nuclear-armed power. This reminds me of the Nicolas Cage movie, Lord of War. They change the flag, they change the name, and the cargo keeps moving. This is the reality of the Shadow Fleet. It is a global network of hundreds of aging tankers operating outside the Western insurance system, specifically designed to evade sanctions. And here is the problem for the American taxpayer. Chasing these ships is incredibly expensive. The U.S. Navy is currently operating under a plan known as Force Design 2045. The goal is to expand the fleet to 373 manned ships and 150 unmanned vessels. The projected cost for this expansion is over $1 trillion. Let that number sink in. $1 trillion. That is money that doesn't exist. It is money that has to be printed by the Federal Reserve. It is money that adds to the national deficit, which is already spiraling out of control. Every time a U.S. destroyer burns fuel to chase a rust bucket tanker carrying discounted oil, the American balance sheet bleeds a little more. It is a classic asymmetry of cost. The Shadow Fleet is cheap, expendable, and decentralized. The U.S. Navy is expensive, centralized, and stretched thin. We have seen this movie before in the Red Sea, where million-dollar missiles were used to shoot down $1,000 drones. Now we are seeing it in the Caribbean. This blockade is costing the U.S. a fortune to maintain. And while it might stop some oil from reaching China in the short term, it is accelerating a much bigger problem at home. The sheer cost of projecting this kind of power globally is one of the primary drivers of sticky inflation. You cannot print $1 trillion for military expansion without devaluing the currency already in circulation. So, when you see those ships turning back, don't just see a tactical victory. See the price tag attached to it. See the inflation that is eating away at your grocery budget. Because this military blockade is essentially a way of bleeding the U.S. economy dry, one patrol at a time. And the worst part is, China knows this. They are happy to let the U.S. Navy exhaust itself in its budget-chasing shadows. Because while Washington is focused on the seas, Beijing is focused on the banks. They are preparing the battlefield for a war that cannot be fought with destroyers or aircraft carriers. They are preparing for a currency war, the financial jiu-jitsu. This brings us to the core of the danger facing your wealth today. For years, the conventional wisdom in Washington has been simple. If we slap tariffs on China, we hurt their economy. The logic is that tariffs make Chinese goods more expensive for Americans. To stay competitive, China would have to devalue their currency, the yuan. A cheaper yuan makes their exports cheap again, offsetting the tariffs. This has been the standard playbook for decades. It is what happened in 2015. It is what happened during the trade war in 2018. So when the U.S. threatened 60% tariffs on Chinese goods in 2025, everyone expected the yuan to crash. Wall Street predicted it. The pundits on TV guaranteed it. But they were wrong. China has flipped the script. Instead of devaluing their currency to fight the tariffs, they are doing the exact opposite. They are allowing the yuan to appreciate. They are letting it get stronger against the dollar. This is what I call the reverse trap. It is a form of financial jiu-jitsu, using your opponent's force against them. Here is how it works, and the math is terrifyingly simple. When the U.S. imposes a tariff, it is essentially a tax on the American consumer. You pay more for the goods. By letting the yuan strengthen, China is telling the world that they are moving up the value chain. A stronger currency means that Chinese companies have more purchasing power. It means they can buy raw materials, energy, and technology from the rest of the world at a discount. Think about it from the perspective of a Chinese manufacturer. If your currency is 10% stronger, the oil you import from the Middle East is 10% cheaper. The copper you import from Chile is 10% cheaper. This lowers their input costs, which helps them maintain their profit margins even without exporting as much to the U.S. But there is a deeper, more strategic layer to this. By strengthening the yuan, China is dismantling the Fortress America argument. U.S. politicians claim that China is a currency manipulator that artificially keeps its money weak to steal jobs. By letting the currency rise, Beijing removes that political weapon. They can stand on the global stage and say, look, we are letting the market decide. Our currency is strong because our economy is pivoting. This makes it very difficult for the U.S. to rally allies in Europe or Asia to join the trade war. If the yuan is rising, the argument for dumping cheap goods becomes much harder to make. But the real danger of the reverse trap isn't about exports. It is about capital flows. For the last 40 years, the world has parked its wealth in U.S. dollars because it was the safest asset. But smart money chases strength. If the U.S. dollar is being diluted by trillion-dollar deficits and endless money printing, it loses its appeal. If the Chinese yuan is appreciating, effectively gaining value while the dollar loses it, where do you think the money will go? We are already seeing the early signs of this shift. At the end of 2025, while the S&P 500 was largely moving sideways, struggling with high interest rates, Chinese markets saw a massive influx of capital. They outperformed the U.S. benchmarks by over 11% in the final quarter. This wasn't just a dead cat bounce. This was global capital reallocating. Investors are realizing that a strong currency is a better store of value than a diluted one. China is effectively creating a new container for wealth, and they are inviting the global south, the BRICS nations, and even European investors to park their money in Beijing. This is the nightmare scenario for the U.S. Federal Reserve. If demand for the dollar drops, who is going to fund the U.S. debt? Who is going to buy those treasury bonds to pay for the 373-ship Navy? If China stops recycling their trade surplus into U.S. debt and starts keeping it in a strong yuan, the interest rates in America will skyrocket. The cost of your mortgage will go up. The cost of your car loan will go up. The government's interest payments on the national debt will become unsustainable. This is the trap. By focusing on the military blockade, the U.S. is blinding itself to the fact that the financial foundation is being pulled out from under it. But a strong currency is only useful if you can use it to buy real things. And that is exactly what China's doing. They aren't just letting the yuan rise to look good. They are using that extra purchasing power to execute the final phase of their plan. The kill shot. The kill shot. A fiat currency like the dollar or the euro is ultimately just a promise. It is backed by faith in the government, but faith is a fragile thing, especially when you are printing money to pay for wars and deficits. China understands this better than anyone. They know that to dethrone the dollar, they can't just offer another paper currency. They have to offer something tangible, something real. They have to offer gold. This is the kill shot of the reverse trap. With a stronger yuan, China's purchasing power for gold has increased significantly, and they have been on a buying spree that is unprecedented in modern history. According to official data from the People's Bank of China, they have been adding to their gold reserves for 18 consecutive months. But that is just the official number. Analysts from Societe Generale and other major financial institutions believe the real number is much, much higher. If you look at the import data from Hong Kong and the withdrawals from the Shanghai Gold Exchange, the amount of gold entering China is massive. Some estimates suggest they imported 10 times more gold in 2025 than they officially declared. Why are they hiding it? Because they are building a great wall of gold. They are systematically converting their trade surplus from paper dollars into physical bullion. This serves two purposes. First, it sanctions-proofs their economy. If the U.S. ever tries to freeze China's assets, like they did to Russia in 2022, it won't work. You can freeze a bank account in New York. You cannot freeze a vault full of gold bars in Shanghai. Second, and more importantly, it prepares the yuan to become an asset-backed currency. Imagine a world in 2026 where the US dollar is backed by $36 trillion of debt and political dysfunction, and then imagine a trade bloc where the currency is backed by thousands of tons of physical gold. Which one would you trust? Which one would you want to use for international trade? We are already seeing Saudi Arabia and other oil producers accepting yuan for oil. They know that they can take that yuan and immediately convert it into gold on the Shanghai Exchange. This effectively means they are selling oil for gold, bypassing the dollar entirely. This is the mechanism that kills the petrodollar. And it is happening right now, accelerated by the very strategy we discussed. The stronger yuan makes it cheaper for China to buy the gold. The U.S. tariffs make it necessary for China to pivot away from the dollar. It is a perfect feedback loop. The U.S. Navy blockade on Venezuelan oil might stop a few tankers, but it does nothing to stop this flow of gold. In fact, it encourages it. Every time the U.S. weaponizes the dollar or uses its military to enforce economic policy, it reminds the rest of the world why they need an alternative. It pushes the global south faster into the arms of the BRICS alliance. It pushes them faster towards gold. So when you look at the charts and see gold hitting new all-time highs, don't just think it is inflation. It is a geopolitical shift. It is the sound of the world's wealth moving from west to east. It is the sound of the dollar losing its exorbitant privilege. China is betting that in the long run, he who has the gold makes the rules. And right now, while America is buying aircraft carriers, China is buying the gold mines. They are securing the supply chains of the future money. From the mines of Central Asia to the deposits in Africa, Chinese companies are using their strong currency to acquire real assets. They are trading paper for rock. And in a currency collapse, rock wins. Paper burns. This is the reality of 2026. The war isn't coming. The war is here. It just isn't being fought with missiles yet. It is being fought with exchange rates and bullion vaults. And right now, the average American saver is on the losing side. So, let's bring this back to you. Let's bring this back to your kitchen table, your savings account, and your future. The events playing out in the Caribbean and in the banking halls of Beijing might seem distant, but their impact is going to be felt in every town in America. The U.S. government is trapped in a vicious cycle. To project power, they must spend money they don't have. To spend money they don't have, they must print it. To print it, they must devalue the dollar that you worked your whole life to save. And while they are distracted playing whack-a-mole with oil tankers, a formidable rival is building a lifeboat made of gold. They are executing a strategic pivot that uses American aggression as the fuel for their own rise. The reverse trap is closing. The dollar is being squeezed from both sides. On one side, by domestic inflation and debt. On the other side, by a competitor that is returning to sound money principles. We have to ask ourselves a hard question. Do you think the people in charge in Washington are simply incompetent? Are they just sleepwalking into this disaster? Or is there a darker possibility? Do you think they know exactly what is happening? Do you think they might actually want a weaker dollar to inflate away the massive national debt, regardless of what it does to your standard of living? I want to know what you think. Is this incompetence or is it a controlled demolition of the currency? Let me know in the comments below. But more importantly, you need to ask yourself what you are going to do about it. If the dollar is under attack, keeping your wealth in a savings account is like keeping ice cream in an oven. It is going to melt. You need to know where the smart money is going. You need to know which assets can survive a currency war. There are only 3 assets that China cannot touch, and that the US government cannot inflate away. I have broken them down in detail in this next video. It is called The Great Gold Reset: Why Central Banks Are Panic Buying. Click right here to watch it. Do not wait until the news tells you it's too late. Protect yourself now. I'll see you there. Stay safe, watch your wallet, and keep your eyes open.